Hello everyone, it's me, the Boss Hog, back with another portfolio update. We've got rid of a couple of positions this week. We've added a couple more. I'm going to talk you through that as well as some thoughts on the week. Let's do it. All right, so in terms of what I want to talk about this week, and there's a few items, but I'm going to start with this one. We've not done a this week overview for a few weeks just because I've been busy, but I've got a few things I want to talk about. The first one is UK inflation. The updated numbers came in way ahead of expectations yet again. I think the most cause for concern was the fact that core inflation actually rose. This is meant to be something that strips out underlying volatility, and what it really suggests is that structural inflation, wage inflation, is starting to become ingrained, which is a huge problem. And I mean, I've been quite critical about the Bank of England for months. I think they were very slow on the uptake. They have been doing a little bit of a sort of mea culpa, please forgive us tour at the moment, including quite weirdly turning up at a food bank, which is strange. And I think they're just stuck in sort of textbooks from the past where, people are meant to act rationally as individuals for the good of the collective. And I think that's been sort of comprehensively debunked, even when I was at uni sort of 15 years ago now. Rational action thought and those kind of like perfect markets and everything else just were debunked. It was accepted that wasn't really how the real world works, and I'm surprised at how long the Bank of England actually took to kind of admit its mistake. I now sort of expect, as indeed does the market, for base rates to need to go up probably a full percent to sort of either 5.5% or maybe even as high as 6%. I just basically think you need to hobble the economy a little bit, frankly. And my point, which has been the case for at least 6 months and probably the better part of a year, is that all that the Bank of England has done will be causing a recession in slow motion. And it's just not good. Basically, you sort of need to take a short, sharp adjustment. I think sort of similar treatments in the 70s and 80s proved that was better. You can compare different country approaches and see that one worked out much better. And I think we're finally getting to that point. So, when this result was published, you'll see one of my positions in Redrow specifically got beaten up quite badly this week. And that's specifically because now the expectation is that with base rates having to rise to get on top of inflation, that will make mortgages even less affordable and therefore put a dampener on things like housing. That said, UK housing continues to prove remarkably resilient, but there is this lingering fear that, first of all, it's becoming increasingly hard to get onto the property ladder. And secondly, that because we have sort of fixed periods, that as they come to an end, people are going to suddenly see their mortgage payments jump up massively. So we'll see how that goes. But there is that fear, and it's completely understandable. Next up is the US debt ceiling. So I made some decisions this week that turned out to be not optimal, and I'll address those in my portfolio update in just a second. But to me, it was surprising, really, because the debt ceiling always feels like theatre, and it is theatre because everyone knows, I think, that unless somebody miscalculates really badly, that they're going to come to a solution eventually, and it's basically just a sort of rubber stamping exercise almost, and it's sort of about both sides trying to emerge as the winner and get what they want and so on. What was surprising is that there was actually a lot of kind of positive coming from both sides, and that seemed to sort of support the market. And yeah, alongside some stellar results, primarily from Nvidia, but then a few others as well, just sort of put a rocket on technology stocks. So I actually, as we'll see, that I could have sold Facebook and Micron at better moments. Still happy because I feel like I sold them at a profit and when I felt like they were reasonably valued, if not slightly ahead of themselves, but the market sometimes, in my opinion, runs a little bit ahead. Saying that again, I'll admit I was very surprised with Nvidia's results, and I think a combination of those stellar earnings and stellar guidance mixed with sort of broadly warm language around the debt ceiling sort of supported a very good market this week. So I think a lot of people will have seen a solid week, as I did, as we'll see very shortly. But yeah, it was interesting. I think it's important when you need to admit as an investor when you got it wrong, you sort of misread the mood music and made some suboptimal decisions as a result. This is really then an extension of tech rising. So one of my best performing positions at the moment is my big tech ETF, Alliance Technology Trust. And in general, it just feels like big tech is almost unstoppable. You do wonder when, like the first company reaches sort of true AI, right? I don't mean like machine learning. I mean sort of almost like a general UI, or at least a heavily directed AI, sorry. And, whether that company will just become an unstoppable beast, right? Because if its AI is good enough, it should be able to sort of almost invest in itself, and that AI should be able to perform sort of exponentially better than anything we can do. So it'd be interesting to see, because yeah, right now it just feels like the big tech is just almost unstoppable. We'll see how it looks. I mean, I would still maintain that probably Microsoft is your safest of the big tech, but it's pretty expensive. But even things like Google, Amazon, Apple, obviously as well, you know, just like the big four, and arguably now with Nvidia sort of pushing the $1 trillion market cap, it may well be another sort of huge company joining them as well. I'm still not really bought into the bullish arguments about Nvidia. It still looks really expensive to me, and I'd actually love to buy into a semiconductor ETF. But the main one I have access to is really overweight in Nvidia, so it had a great week, and to me already looked expensive. And so now I feel even less willing to buy into it. I do still have quite big semiconductor exposure even after getting rid of Micron this week, and it did do very well, as we'll see. But yeah, my general thoughts with Nvidia specifically is, you know, like that a lot of the other big boys are going to start to want to produce their own chips, which I think is a direct challenge. And again, I mean, I think there's almost like at risk of being overhyped about AI. We'll see how that shapes up. Maybe I'm being, again, misreading the mood music a little bit, and everyone is really excited, and actually AI will start fundamentally delivering. We'll get to the point, like 2 points down in a sec, about BT this week, but you know, BT are looking to basically make half of their workforce redundant, and part of that is basically a technology upgrade in the infrastructure component, but also half of that is around sort of getting rid of customer services agents, where it's believed that an AI can do it smarter and cheaper ultimately. So it'll be interesting to see how that looks. And then also in my sector, I guess, was Octopus Energy, which a couple of weeks ago went live with the fact that they've got rid of 200 customer services positions, although interestingly haven't got rid of the people. They've kind of moved them into different roles. But yeah, they're sort of a newer challenger, but I think it's also interesting to see that you're starting to see these numbers come out now that will become quite significant quite quickly, and people are reading different things into that. Again, I'm not quite as sold into the hype as maybe other people are in the market in general. I'm probably running behind the market, just because I've been in rooms where people talk about, you know, digitalization or automation and things like that, without really understanding that, you know, you need very clear, robust, non-caveated processes for AI to have a chance of doing it. And that's, in my experience, not really how most businesses are set up. You know, they're like sort of 80% of their business model might be sort of cookie cutter and standardized, but then the other 20% is when the tech is going to fundamentally fall over. So you have to be, you know, you're typically doing it in like piecemeal integrations across a process, and you end up with challenges as you start to piece that together. It's not so straightforward, basically. So I think there will be challenges, and it's going to take a lot longer than people expect. But again, I may be wrong, but I think it's worth talking about. I thought this was also really interesting. So as critical as I have been about the Bank of England on rate increases and inflation, I think they published something this week about the fact that they were going to be classing crypto as gambling rather than as investing. This has kind of quite significant implications for things like, you know, are your investments protected, right? With sort of regulated cover, which regulator is ultimately responsible for it, those kind of things as well. And people were quite divided about this, which meant that I sort of feel like I have to pick a side as well, because I've been quite verbal and critical about crypto. And, you know, I'm actually somebody who both invests and indeed likes gambling, right? I may well go to the casino literally today because I've got a day off. And so, you know, it's not like I don't mind either scenario. I think it's your money to do with as you want. But I think we have to be really clear on what crypto is, which is it's a form of speculation. And I'm not talking here about like the blockchain or any underlying utility that you might get from it. And I'm not talking about things that are sort of, you know, structurally backed by centralized governments, sort of so-called stable coins, but I think I mean like linking it specifically to, you know, a digital version of an actual currency, which is, again, which it's underpinned by some kind of basics, right? Like the rate you can get by investing in that country, for example, will have a direct impact on the movement of the currency. And for me, I look at, let's say, Bitcoin, and I don't see a utility, and I don't really see a way of calculating the value of Bitcoin. And every time sort of somebody comes out with one of these ridiculous numbers like Bitcoin to 50,000 or 500,000 or 100,000, it's always suspiciously arbitrary, right? and round. But secondly, like, how is that calculated? Because with a stock, I can pick it up and look at, you know, earnings or cash flow, or, you know, do a DCF calculation over a period of time and work out, you know, its sort of value. And I just don't really see that. So really, you're buying Bitcoin because you've speculated that you can sell it for more than you're buying it, and that's fine. That again, there's nothing wrong with speculating. Use your own money to spend and invest and gamble however you want. But I think it is important to recognize it for what it is, which is literal speculation. And therefore, to me, I think it makes sense that like I don't want to be basically financing people's moral hazard. It's like, you shouldn't be expected to cover my gambling losses, right? And I shouldn't be expected to cover your poor decisions as either a gambler or, an investor even. And again, most of the time, like if you're investing in a company that turns out to be a poor investment, that's like buyer beware almost, right? Like I'm not going to go and ask for support because, my shares in Evraz got absolutely wrecked because of a war, right? And then the government chose to impose sanctions, right? That's just a poor investment on my side. And I didn't give enough weight to geopolitics in my investment decisions. Okay, I made a mistake. And similarly, right, like if you want to put part of your portfolio, I would suggest it should be a very small percent into speculation or high risk stocks even, or high risk positions, which I think could include crypto if we're using the word positions instead of investments. That's fine. I think that's perfectly okay to do. But we just need to be honest with ourselves about what crypto is. And to me, I don't think it's a good idea to call it investing. I don't think that you should kid yourselves that it's an investment, right? Like looking at lines on a graph and feeling like you know something that the market doesn't. It's like reading tea leaves. And by the way, speaking of gambling, that's what I see. Like whenever I play Baccarat, or I don't play roulette, but similar as well, like they put previous results on there, and especially with Baccarat, it's like it's a very Chinese dominated game. It's like people just think they see patterns in tea leaves, and they'll just suddenly come in with like these huge bets, which may or may not work out, right? And it's kind of like either vindication that they saw something, or maybe they didn't see it correctly, and I'm just like, it's literally exactly what I see with people who are like reading lines on graphs and talking about moving averages and support levels and stuff like that. I'm highly doubtful. If you can make it work, of course, then great. I think that's awesome. But yeah, I think in terms of regulation, how it's marketed as well will matter by this decision. And I just think like the UK shouldn't be so desperate to become a leading crypto that it kind of overrules a very clear distinction to me between investments and let's call it speculation. So yeah, for me, I'm a big fan of this. I think the Bank of England is correct in its initial publication, and I hope that they will sort of follow it through. Lastly, this is quite industry specific, but as kind of somebody who talks about telecoms quite a lot and spent an hour talking about Vodafone last week, I felt like I should talk about Equinox too. This won't mean much to anybody outside of the industry, but actually it's hugely important, and I think I should address it. So Equinox 2 is basically the decision that Openreach and Ofcom have reached about pricing for next generation connections, let's call them. And the reason why I find it very interesting is because this was challenged by primarily a company called City Fibre, and they're kind of leading this challenge from the point of perspective of alternative networks, so people who are trying to build additional network capacity. And the reason why they're leading this is because they're basically fully exposed to wholesale. And what Equinox does is it basically changes the pricing that Openreach agrees with wholesale partners, and therefore it makes City Fibre's offering a lot less competitive. And in general, what it does is it kind of kneecaps a lot of other altnets. Again, City Fibre are most exposed because they, as far as I'm aware, they only have a wholesale sales channel. They don't sell directly to customers, residential. And yeah, for me, it's really, a poor decision, I would say, by Ofcom. And I'm going to be quite careful here in what I say, because I do have some, informed news from sort of people who know, but the general consensus I think across the industry is right now Openreach is basically able to guide Ofcom, and Ofcom is kind of like making quite poor decisions about the kind of what it's meant to represent, which is the competitiveness of the market. And really what they've done is kind of undermined the business case for literally dozens of other companies who would very much like to build their own network and then be able to compete against Openreach. And it kind of insulates Openreach a lot against these challenges, which are kind of, some of them are quite powerful and sort of private equity backed and etc. And so not only does it provide them insulation, but I would argue basically enables them to move to next generation architecture from sort of old school copper lines into newer fiber a lot less affordably. And, I think for them, like they were praising about the fact that, they don't have to be private equity backed or anything else. And that's very true because, of course, they're a big incumbent and they've got this, that they are profitable as a business and they do all sorts of investments. But yeah, I think what it basically means is that the UK will not be served especially well by continuing to have a single national-wide network and with very limited competition on it, because ultimately all the pricing is set by Openreach and Ofcom. And like the relationship between the regulator and the incumbent is just so cozy at the moment that like the board level members of Openreach just spend days every month in the offices of Ofcom, which just seems very strange, and I think in most other industries would raise eyebrows. I have heard it said that basically government is starting to also wonder the same thing, that this is kind of such a weird decision. And it's now believed that even though Ofcom delayed this on the challenge of City Fibre, they basically just came out with exactly the same results. And really the reason why they did this is to get their own legal defence in order on the assumption that City Fibre will continue to fight this very aggressively, including taking it to court. So we're basically getting their house in order. So for me, I think it's a really poor outcome for customers in the medium to long term. There was some suggestions that with the delay was a bit of good news, which is that Ofcom promised not to change the pricing for the next 3 years. But again, it's kind of caveated so that actually basically if anyone with an interest seeks to challenge it, then they can just raise a request to bring forward pricing. So it doesn't really matter what this concession is. And to me, I just think basically that Ofcom is sort of sleeping on the job at the moment. Looks commercially very inept, and yeah, kind of I just think it's like a missed opportunity basically. To be clear, I do have a horse in the race because I work for one of these altnets, though not City Fibre, and I've worked with Ofcom directly for over a decade, including attending their strategic reviews that they give to telcos twice a year. And it's not the first misstep I think they've made, but now the question is like beforehand, at least you could think that Ofcom were trying to represent the interests of the customers, but we're kind of making some missteps like this. But this just looks so poor and so obviously detrimental to customers, because instead of there being dozens of competitors, each being willing and able to offer attractive competitive rates for going onto their network, you're basically helping insulate the incumbent. And I think as an extension of this, by the way, like whereas I was quite negative about legacy telcos last week and Vodafone in particular, I think BT actually may well now look a bit undervalued. And so for me, whereas like I think that buying a stake in Vodafone is a bit mental, honestly, unless you're really going for value and hope it's going to be split up, with BT it makes a lot more sense because like I say, they're not dealing in a market where the regulator is really aggressive like they are with Germany. They're actually having the opposite, where the regulator is really friendly and kind of helping them out. And when you actually look on top of what else BT has, I think you could make an argument that they're sort of 10 to 15% undervalued. And they're also being supported by quite an aggressive buyer. In this case, Altice from France, who has a good reputation for being sort of quite cost conscious, let's say, and should sort of drive those conversations within BT. And it'll just be interesting to see how it shapes up. So very UK focused telco news here. If anyone wants to read up on it, it's called Equinox 2. But yeah, it's quite an important thing and will have ramifications for years to come into the competitiveness of the UK landline market, specifically, copper to fibre migration. So it really matters quite a lot in my opinion. Anyway, so I had a few things to talk about this week. Let's move on to portfolio. And then I'm also going to have a walkthrough of one of my new positions and explain why I got them. All right, so in terms of portfolio, I thought this was actually quite useful to do last week as a catch-up, so I've decided to do it again. I was paid in late May, so I've put in £1,600. I do expect us between now and the end of June to not add a ton. We'll basically have a bunch of spend that me and my wife want to do, probably about 1,600. So I think whereas we're currently running a few weeks ahead of our investment goals, we've had a conversation and, I'm basically agreed that we can probably wait for a few weeks before we put anything else on. Honestly as well, because now the market's run up a little bit, I'm kind of a little bit, everything looks a bit more expensive than it did even just a week ago. I know I shouldn't think like that, but it's also quite hard to not think like that. I'm sure everyone else can relate. But yeah, just as an FYI. This one, though, is quite interesting. So this is a withdrawal, and you can see it basically matches our Games Workshop dividend. So Games Workshop is by far the largest position that sits outside of our ISAs. It sits in a general investment account. And a few weeks ago, I actually sold about half of my Games Workshop position, and that's because I needed it to, pay less than £500 a month dividends. Otherwise, sooner or later, I'm going to have a big fat dividend tax bill, basically. So right now, I think the level of Games Workshop that I hold is about right. But I decided again after conversations with my wife, where I'd be like talking about dividend income and things like that, and she'd always be like jokingly, she's like, "Yes, but Liam, what about cold hard cash?" So I made a bit of a deal about it, and basically withdrew this cold hard cash. Like, there's no tax implications; it doesn't sit in an ISA already. So I was like, do you know what? I might as well withdraw this, and we've agreed, or I've agreed with my wife, that we're going to use our Games Workshop dividends, which should be the better part of £100 4 times a year, to basically go for a nice family meal, so that we can start enjoying some of the immediate benefits of having investments, right? Because at the moment, all the focus is on reinvesting. And I know, of course, it would be financially better to invest this for the future. But there comes a point, where it's like you want to start living for today just a little bit, and going for a nice family meal, me and my wife and daughter once a quarter, and basically using Games Workshop to do it didn't feel so bad. So I think that's actually going to be the plan moving forward, where we basically just use it as a nice little income. And Games Workshop is also in the general investment account. Is sort of a non-ideal emergency fund, and I know I shouldn't have my emergency fund in shares, obviously, and the plan at the moment is to basically be adding to my premium bonds to be using that as an emergency fund instead. But it is the better part of £10,000 in our emergency fund / general investment account at the moment, so it should be good to stay there for the foreseeable future. Now, in terms of sells, this bottom one here is actually a new position, and as I was buying, I was like a penny over, so my brokerage sold it for me forcibly. So we can more or less ignore that line for now. We'll get to them in a moment, though. But I did decide to sell out Meta, and the main reason here is I got into Meta just over a year ago on the basis that it looked cheap, but I was never really into the Realty Labs or that kind of stuff, the meta side of the business, basically. So for me, it was all about Facebook looking a little bit undervalued and a little bit beaten up. Now, of course, it fell so much further than I think most people would have expected, right? So at one stage, I was down well over 50%. So I sold this for 16% profit, which I was really happy with. And I basically told myself that it got to 250. This was close enough to 250, that I would sell it because I was happy with it. And I was never really too keen on Meta anyway. I kind of regretted buying it. It's not my kind of company. It's not a product I use. And my thinking was this basically almost looks like a free bet on Realty Labs, and so far I haven't really been impressed in, to me, what looks like a bit of a money pit. So yeah, I decided that if I exclude Realty Labs, the rest of the business looks up to date at $250, and I appreciate, of course, that later on in the week it was significantly above that. But at the same time, for me, I'm happy with my profit, basically. And like I say, to get out of a position I never really loved anyway. Micron was a bit different, and maybe I didn't have to sell here. And you can see, I got a $66 exchange. So again, that now looks like a dreadful decision. These sells, not selling on Friday and instead selling on, Wednesday, probably cost me about 200, just over 200 quid. So it's not the biggest amount of money for a portfolio this size, but it's also man, I didn't time that particularly well. And again, my thinking was that actually Nvidia, if anything, was going to disappoint the market because it already looked so expensive. And I didn't want to buy any more shares anyway, because I thought, again, the debt ceiling would be a continuing drag on a sentiment. And so, when the news came up about the fact that Micron looks like it's about to be caught in a bit of a trade war, and, you've got the good news coming from Japan and then the bad news coming from China, and it's only sort of about 11%, I think, of its earnings are from China. So it's not huge, but it's also not trivial either. And it was more again, I think because in the past I didn't react quickly enough to the Evra situation, and to a lesser degree Polymetal, I'm sort of hypersensitive now about political pressures. And again, I had an opportunity here to sell this at a small profit. I think in the end it was 4% profit, so hardly amazing, although I do also have some dividends from Micron as well. But yeah, I just decided that I wanted to escape it. And of course, if I'd have had a crystal ball, I would have let it ride up another $5. But when I'm looking at its current price to earnings, it looks like it's months ahead of itself. And again, I think I'm okay selling it, even though, again, with a crystal ball, I would have sold it a few days later. I think the reasons for me selling it are still justifiable, so I don't regret it too much, other than having, perfect knowledge. Everyone's an expert with perfect information and hindsight, so that's fine. In terms of my buys here, so it's a little bit of I don't want to call it a scattergun because there was method to the madness, but like if I go down these first ones here, these are in my wife's ISA, and my wife's ISA actually looks pretty healthy at the moment, with maybe the exception of Gamma and Genie, which is still pretty red. But actually, the ETFs themselves are in a pretty good position overall, and I've also got my Alliance position there, which is up like 20%. So here I'm just like basically diversifying over a bunch of things. And yeah, so I would say at the moment that my Canada one, which I sold out of a few weeks ago in all but one share, now looks pretty good value again. It's kind of trading quite a narrow range, so I might actually look to see if I can do a bit of sort of swing trading on this ETF specifically. It's had a bit of a pullback, even though it's like 40% financials, and I would have thought that, you know, most of the financials are moving in a positive direction at the moment because, you know, a major bank hasn't gone under, and a lot of the net interest income that banks make should be benefiting from higher base rates at the moment. So I'm sort of a bit surprised that this ETF has had the pullback that it has. I sold really well here, and maybe we'll be able to get back into it quite ideally. So I'm considering actually putting a bit more money in probably the next time I top up, if I can get this Canada ETF here, which is HCAN as the ticker. I may well do that. And then if I go over to my ISO, my name, I continue to average quite aggressively into Scottish Mortgage Investment Trust. This is basically my, let's call it speculative tech, but it's not really. I think, again, it's kind of misunderstood a little bit as a fund, to be honest. So 30% of it is private, but when you actually look at the private companies they have, most of them are like quite late stage and already very profitable and very large. They're not really dealing with sort of small, unproven companies. You're already talking about market caps of like billions for these companies, right? So I think, again, like the position, like, and the way Scottish Investment Trust also prices its private holdings, I think is very understandable and fine, all above board. So yeah, very happy at the moment. I'm still about 9% down on SMT, but again, for me, it's like a 5-year plus, probably a forever holding, to be honest. So I'm quite happy just to be averaging into it and bringing my average closer and closer to 700p, so £7. On top of that, I also went quite aggressive into mining this week. Like my mining position, my unrealized position in this ETF is quite red, but I did sell out of it because I moved it across ISA. So broadly speaking, I'm about flat. And yeah, I just like the defensiveness slash commodity aspect of this. So again, it's a couple of percent of my portfolio at the moment, but I'm looking to add to it. And so for me, on a bit of weakness from China primarily, it was a good chance to buy. Then I wanted to talk about two positions in a bit more detail, and these are like both new positions, and we're going to look into detail on this one in a sec. So BlackRock Throgmorton Trust. I will get better at saying that, but it's not the easiest thing to say for some reason. I would describe this ETF as basically UK high quality, small to mid cap ETF. That's how I'm going to phrase it. It's a mid-sized ETF. It's not huge, but like when you'll see in a second when we look at these holdings, like I think it reeks of quality. Basically, you've got some good outperformance. You've got a modest discount to its net asset value. I think I've honestly found something that I've never heard anyone else speak about before, and I'm really pleased about it. Like, I just love the positions. I'm really excited about it. This is kind of exactly the kind of ETF I want for my sort of risk profile and time horizon. So again, we'll have actually a look through their portfolio, which is very clear and detailed, and for me it just makes a ton of sense. And then if I was to speak here and try and describe Fidelity special values, I would describe this as basically UK focused value. I think it's kind of got a lot of positions and a lot of rationale in those positions that resonate with me personally. Like, they're really bullish, for example, on the UK insurance sector. Again, I continue to think the UK insurance sector is a massive opportunity for income focused and defensive minded investors at the moment. I think you can basically pick any insurer from the FTSE 350 and find a good opportunity there. Similarly as well about UK banks. Again, I think UK banks are actually some of the best run now. We kind of learned our lesson, I think, from 2008. I think the net interest income will be beneficial to them, and I think the worries about provisions and, you know, debt and everything else are massively overdone. So, you know, I'm not my argument still remains that I don't believe everything that's happening at the moment is systemic. It's basically relating to banks mismanaging risk, which is a problem for a bank, right? But I don't believe the system itself is problematic in the same way it was with 2008, when the whole system had a problem with risk allocation, right? That was ultimately what the problem was, is that CDOs, collateralized debt obligations, were sold at multiple risk levels and bundled together, and nobody knew what the value was, so nobody could price the risk. So that's systemic because everyone was taking part in that market. What's been happening with, like Silicon Valley Bank is a lot more specific to that bank. And sure, other banks are going to be impacted by the way that interest rates have suddenly shot up, right, depending on how they've hedged and all the rest of it. But again, it's not the system itself which is problem, it's the risk allocation in response to a macroeconomic situation. So for me, they're fundamentally different, and I think UK banks at the moment are increasingly good places to put your money. In the past, I actually preferred US banks, but I think at the moment, like the regulation there kind of incentivizes moves to bigger banks in the US, and I don't think there's anything wrong with owning JP Morgan or somebody like that, but I think right now individual regional banks are high risk, and that was actually why I sold out of Huntington a few months ago. Now again, I was very mindful about non-business things, as I was with Ezraz and I guess Micron as well. So this one is really cool as well. I would like to do a bit more of a deep dive into this, but it's got a lot more companies that I think people will be familiar with. Your sort of like NatWest or your Legal in General and Phoenix all have big positions up there as well. Aviva likewise. So we basically got 3 of the big 4 UK insurers. So yeah, so for me, I'm really excited about both of these positions. They basically fulfill different niches for me. One of them is UK value and one of them is high quality UK growth. And to me, that's super cool to have ETFs that I can get excited about, because not all of my ETFs I'm equally excited about. Like my one in consumer staples is definitely not there. So yeah, so that's my buys, and we'll do a look at BlackRock in just a second. In terms of my performance this week, really pleased, honestly. I have a very tech heavy portfolio anyway, so it might not surprise anyone that I was a big winner this week. In terms of my performance here, I still maintain this is my most important data. It's the one that I care about the most. We're now back above the S&P 500. I hope to be catching up the FTSE 350, which actually hasn't had a very good May, interestingly enough. So yeah, some of my UK positions have actually underperformed quite significantly, but my US ones are carrying me. And again, we're kind of seeing the same here with the indexes. The all world, interestingly, continues to significantly underperform, but you can see here the top 3 it's pretty close basically. We also reached an all-time high of our portfolio value. It has been over 138,000. You can actually see here my trading 212 is actually above 138, so that's awesome. Pretty close delta, so I'm pretty happy at these kind of differences. Again, you've got sort of FX movements, really tiny differences in sort of spreads most of the time. By the way, I don't know where my graph's gone here. There is a graph as well, but it seems to have disappeared at the moment. I'll try and fix that. But we have now deposited 6,400 of our 40,000 target for the year, so that feels really good. And yeah, honestly, I've had a very good May. You can see here, like across 4 weeks, which basically is May at this point, right? We've added 7 grand to our profit. Nearly 9,000 to our portfolio, which does include some deposit. And by the way, here the net deposit, right? This is an important consideration. We added 1,600 as we touched on, but then I withdrew 88, right? So again, this is how we measure our net deposit. So nothing untoward. It's just unusual to see this less than deposits, but that's why it's incredibly rare for me to withdraw money. But now that we're going to be doing this basically once a quarter, that will become a thing. If I scroll down, we're also, if my benchmarking is the most important, I would actually say this is the second most important graph, which is my profit over time. And again, this is now, like, I'm so non-moved at the moment when the market is having a good period, because this is now the 6th unique time I would classify, maybe even the 7th if you wanted to, right? You've got 1, 2, 3, 4, 5, and now 6. So 6 distinct rallies in what still to me looks like a challenging market. So, the reason why my 14-week performance is still negative is because it's comparing against this all-time profit high in early February. You can see here, though, a huge drop, and now, okay, it's recovered a lot of that way, but still not where it was. So, again, this has happened multiple times, and I'm not going to assume it's suddenly going to explode in value or anything else. We're just trusting the process, adding, etc. And, even though I mentioned about the fact that everything looks expensive at the moment, like, that's just a very initial reaction. Like, I know that I need to keep averaging in, and 20 years is so far away that honestly £100 here or £50 there or percentage movement here doesn't matter in the scheme of things. So that's cool. And likewise, what else is cool is now this blue line here, which is our growth basically. So, we're comfortably now profitable because both the blue and the pink line are above our green. So, not quite the highs of yesteryear when there was a significant profit there, but I'm really hoping over the long term that this will start to become a more important graph as dividends and growth start to matter more and more.
So if I just have a quick scroll then through our portfolio at the moment, so this is organized by market cap value. So Gamma continues to have I would say it's kind of found its grounding in the sort of £11.50 to £12 range. I still don't think it's a particularly expensive stock, considering the quality, considering 10% of its market cap is held in cash, considering its growth prospects, its dividend growth prospects, and its kind of how it's positioned itself for the next decade in terms of telecom movements across Europe. I think it's a really strong company, so I still like this company even at £12. By the way, I have a £19 conservative, I would say, target for this company at this moment. So again, hugely optimistic. Amcor had a really good week, as did most tech and semiconductor focused spot positions. So yeah, again, I think here this is I've got a 36% $36 target. So again, I'm in no rush to do anything with this yet. Really strong conviction for me is Amcor. Likewise, what's become a strong conviction for me is Genius. Now, I think this should be a $6 share at the moment. So it broadly is caught up, I would say, with events. But super pleased. I mean, anyone who got it, when it's like 83%, you can see the year-on-year change. Anyone who was buying this in the $2, I think you picked up an absolute steal. I do think that the next stage of its journey is going to be into profitability, but so far it's had a year and a half almost of consistently hitting targets. So I'm really optimistic. I love the direction of travel. SMT likewise, little growth here, but you can see my big four have all had pretty good month to date, so that's definitely helping. And there's likewise a lot of green here in my month to date as well. So again, we're up like 5% on the month, so very, very good month. My UK financials, and to be honest with you, most of my UK positions are struggling this month. That's definitely the negative in my portfolio, I would say. But yeah, there's been enough sort of weight in the kind of big positions and sort of tech to carry me a reasonable amount. So Salesforce, I did see a video by Joseph Carson where he sort of sold out of Salesforce and bought into Intuit. Now, as a UK investor, I only really know Intuit from MailChimp, which I think is an okay marketing tool, but actually doesn't really fulfill what I need it for. And interestingly, my employer at the moment is moving away from MailChimp to a different provider. So like the problem with marketing comms is that they tend not to be very good at sort of storing things like orders for audits or assurance things, and so it's a very marketing heavy tool, and I think it kind of runs out of its use as soon as you get to a reasonably large business, which in fairness may well be how they position themselves. And I also understand they do a lot of tax stuff in the US where I don't really see that, so maybe Intuit's good from that position. I still like Salesforce. I get that there's a lot of sort of employee compensation at the moment, and it probably, if I'm honest with you, needs a slightly stricter governance management to it, but I still really like the technology stack that they've built, and I know a lot of my peers use it and work with it, and I just really like it. So I did actually think about whether this was starting to become a good thing to consider selling, but I want to ride it what I hope will be a little bit higher, and yeah, we'll think about it in the future. But for now, I'm quite comfortably green actually now on Salesforce, having spent a lot of the last year red, and like I say, I did think about selling, but I think I'm going to hold it. So for at least until we at least start getting to like the 250 somewhere around there, I think it still has a solid sort of 10 to 15% left in it, and then we'll revisit that as results come. Either we'll reduce that or we'll add to it, and we'll make a decision. ASML again, semiconductor. I really want to keep. I have zero interest in ever selling ASML. I think it just has one of the strongest moats, one of the most important European technology companies that there is. And actually, a few of my ETFs have exposure to ASML, so I suspect actually my position in ASML is significantly higher than this. It's the joint largest position now in SMT. It's in my Dutch ETF, right? I actually think my weighting of ASML has probably got a couple of additional shares in than this is showing. A bunch of sort of modest movements. Redrow is the one I mentioned in my introduction, right? It's my UK house builder of choice. I already think the sector was beaten up, so to me, it's like, yeah, maybe, the news about inflation and suspected base rate increase, it will have an impact. But again, I think the falls here are a bit unjustified considering it was already so cheap. DLR, again, has got exposure to sort of AI, tech, and everything else. Crichton's is an interesting one. This is my sort of penny stock that's linked to consumer goods. I am surprised it's still at this level. It sort of hasn't really recovered from its sort of surge that it had during lockdowns in the products that it does, which is like soaps and stuff, right? But I still like this. I did revisit it before about 9 months ago and had a bit of a deep dive into it. I still like it, but again, it's not unusual to see this move by a reasonable amount. And then everything else, again, these are a little bit frustrating. I've left these here just for the zeros. I don't have an active position in them anymore, but it's you can see how they've also had very solid weeks. Interestingly, I did sell Fever Tree before they published their formal results, although they'd already given a trading update. So I sold them at 14.42, thinking it was basically ahead of where it should be. I would say the results were no surprises, and I think if you're, basically the results won't change your position. If you think the price is too high, you still think the price is too high. If you think it's got further to go, you still think exactly the same. To me, it was kind of reassuring. Again, I sold out of Fever Tree because I'm concerned about the execution risk. If they execute flawlessly, I can easily see this running higher, to be clear. But I've lost confidence in their ability to execute what I think is the correct strategy, the correct product, and everything else. I've lost that confidence. So I think for me, it was fine to sell. And again, I was actually quite pleased to make some profit here. I kind of benefited from this run up, the sort of 30% across the last quarter. So decided to take advantage of that. So yeah, that's mostly it for my portfolio. You can see here I'm still 40% on tech. As I buy more ETFs, it's starting to become a larger part of my portfolio, and then I basically break it down by the largest position in that ETF. And yeah, total dividends now above 6,000, so that feels good. And I don't really have anything else to add. So without further ado, let's have a look at my new position, and let's see if I can convince you that it's a really good thing I've found. Alright, so we're now back to Throckmorton. This is just from their website. So first of all, one of the reasons why I really like this is it's UK focused. I already have a US focused, small growth companies, which is IDP6. That's actually quite a big position, down just a few percent at the moment, so very fine with that. Now, they are allowed to invest, I believe it's up to 15% in non-UK items. They're also allowed to invest up to 2.5% in private companies. So that's kind of interesting. Nothing like what SMT have got with their 30%, but kind of interesting all the same. I also think the split here is, again, interesting. You've got like industrials and consumer discretionary. I do have a bit in consumer discretionary, but it's definitely all focused basically on Games Workshop. So for me, it's a good opportunity to expand both of these parts of my pie, which are maybe a little bit underrepresented. And then, we've got the financials here. Nothing unusual to see a fairly chunky financials in UK. And then actually relatively small rest of it. So first of all, I think this is fine and a little bit different in terms of that. If I scroll down, we'll have a look at their full portfolio, but this basically they update their top 10 every month, and then their full portfolio is once every 3 months. So because we're doing this in May, we're sort of between those things. So first of all, I'll just zoom through the top 10 here. Gamma Communications, need to see more, good spot. Everything else. This second one here is interesting. A good friend of mine has a fairly chunky position in watches of Switzerland, and I'm kind of a bit jealous because I do have a bit of a soft spot for watches. It's kind of one of those things that maybe one day when I retire, it'll be a little bit of a passion for me to have a couple of nice watches. But the company just seems to be quite bulletproof almost and continues to just progress very nicely. So I think that's awesome. I've never owned this company, but it's kind of a company I'm broadly familiar with, let's say. WH Smith, I've actually swung traded quite successfully a few times. It's interesting that it's a top 10 because it's definitely had a difficult few years, what with its sort of travel focus. But again, I do think there's some good value to be found in WH Smith. It's a good brand in the UK, and increasingly, although it doesn't trade under the name in the US, it's sort of establishing itself in a lot of airports and ports and those kind of things with very good margins. I've been really impressed with how they've managed to position themselves. CVS is an interesting one because it's basically a veterinary group. Broadly, I have been at Pets at Home before, and I've also looked into Decra, which sort of has pharmaceuticals aimed at vets. So this one for me is an interesting one. I'm not super familiar with CVS group, but again, I think it's definitely the case that Brits do love their animals, and maybe it's a company I need to look into a little bit more. Then we've got Grafton and Breeden. Both of these are basically construction companies, which again, I think have performed quite well. I think I've never owned a construction company, but I know some people who watch my videos have. And I think it's a fine, basically, a shovels kind of play onto the sector. I think there are good opportunities there. It's similarly underpriced like house builders, but you're less exposed in a way to some of the shock movements with base rates, etc. Although obviously I think you are still exposed to some degree. Then we have like a professional services group basically in 4imprint. I can't say I know them super well, but again, I've heard about them. Ergomed was actually a company I've never heard of before, and I did have to do a little bit of digging to understand it. It's been around for quite a while, but it's basically a specialist pharmaceutical company. I think it does a lot of sort of testing that kind of stuff as well. But it's pretty interesting. Again, another company that maybe warrants a bit more attention. I think Diploma is. I know there are guys that playing footsie like Diploma again. I think it's a solid company basically that's kind of flying under most people's radars. And then Oxford Instruments here, you've kind of got that tech exposure. It's sort of a specialist manufacturer of tech. So again, there's some really good quality companies here. I also like the fact that this ETF is quite focused. Top 10 is almost 30%. You're like with my Fidelity Value one, it's a lot broader, and a lot of the ETFs I've been buying recently have been very broad, right? Like the IDP6 is 600 positions. You can get similar with like Russell 2000, right? Looking across thousands. This one is pretty focused, which I personally like. If I just, so I'm still on the main page here. If I go to comparison, one of the nice things I wanted to highlight. So first of all, it's fallen a lot in value over the last couple of years, and I think broadly speaking, that's overdone. But if I look here at the price return, the returns, I think this is a really solid last few years. I get that 2022 is a bit tough, but actually most people lost money in 2022, right? Most markets underperformed. Certainly their UK focus here will be beneficial because I think the FTSE 100 is one of the few companies to have made money. One of the few indexes that was up last year. And likewise with, FTSE 350 would have done fine. Most of these positions, by the way, are more like FTSE 250 rather than 100. Just because it's focusing on the growth companies, or even like AIM and things like that, right? There aren't a ton of FTSE 100 companies here, but there are a lot of in the 250. But yeah, these are great returns, and again, for me, I think there's tons of value. One of the other interesting thing that both this ETF and Fidelity's highlight is the fact that at the moment, between a relatively weak pound as well as sort of an underappreciated UK holdings, there's actually a lot of investment opportunities from overseas. So, like a lot of these companies have an opportunity to be purchased. And I completely agree. Like, I think if you've got dollars and, you're looking to buy a company that's maybe undervalued, I think you've got an opportunity here, basically. So I expect a lot of private equity money to come almost flooding into the UK as soon as base rates start to normalize. Right now, I don't think you're necessarily seeing that because you can get such good returns just putting it into the bank. But I do very much expect that there are some good value plays. And again, to be clear, I don't necessarily think this ETF is primarily value. I think there's tons of quality into it. But I do expect these kind of fairly chunky returns, which is also why I'm quite excited to get into it. So if I just look at their full portfolio, I'm just going to whiz through this. But I think, if anyone sees any companies here that they're interested in, I will happily have a look. Just a little bit of movement month on month. You can see maybe Breeden's gone down a little bit, but Watches of Switzerland's gone up, things like that. So we've already looked at this. YouGov is an interesting one. Basically polling, right? As far as I understand it, at least. Games Workshop here. This is obviously another significant holding for me. I think it's again really undervalued at the moment. Undervalued, just a little bit undervalued. It's had quite a significant run up. I still think it should be more like 110 to 120. So I guess from that perspective, you could say I still believe there's still a reasonable run up there. But that's awesome. Quinitech here, defense company. Again, I don't have anything in defense, so for me, it's a good opportunity as well. Dunelm here, I think, is a really great consumer discretionary holding. It's a really good quality company with a good brand in the UK and well run. It's basically outperforming. Chemring here as well, another defense company. I think there's some good plays here in terms of the air sector as well. So for me, that's exciting. Got some insurance here, some recruiters. Hiscox is insurance. Robert Walters is white collar recruitment, basically. I just scroll down. This Salesforce is an interesting one as well. Clarkson's Shoes Zero. I did want to talk about this because one of my biggest regrets as an investor is basically identifying a company and then not sticking with it. And that company was the Sage Group, SGE. It's one of the few FTSE 100 tech companies. And I did really well out of it in theory because I made 30% and got the dividends and everything else. But I was buying it in the 440s when I first started investing. And now it's at 800 and something. And Sage is sort of the go-to ERP system for and payroll and a few other bits if you're a kind of mid to larger company. Zero is kind of interesting in that it feels the smaller. It's basically a small version of Sage. It's less good, I think it's fair, but it does a lot of the similar stuff and it's cheaper and it's a very good entry into sort of some of the systems and processes you need when you start to become, too big to do stuff in Word and Excel. So that's cool. Money Supermarket as well is an interesting shout. If I just carry on scrolling down, Kia here. I mean, I see a lot of their holdings are in construction. Again, kind of interesting. Cranswick here is also sort of one of those mainstay companies that no one's ever heard of. This is a sausage maker, but quite a significant one. It's a major supplier, and yeah, it's cool from that perspective, shall we say. They've also got Redrow here in theirs as well. And then if I just go to page 2, you can see here, by the way, we're down into fairly small positions now because it's relatively heavy. But the big one I wanted to call out here was one of my favorites, which is Cerillion. So I used to own Cerillion, but I basically had to sell it because I had a conflict of interest at work. But my job, which is basically billing systems for telecoms companies, is literally what Cerillion do. So I feel like there's rarely a company that I feel more informed about than do with Cerillion. I really like their product. I know their sales development director very well. He's on my LinkedIn. Everyone I've ever met at Cerillion is really knows their stuff. And again, to me, I feel like I really know my stuff when it comes to billing systems. And I had to sell this at 700p, and now it's trading on the better part of 1200. It might look expensive because it trades on a fairly high multiple, but actually I think it should be even higher. And I would say it's only not even higher because the founder and current CEO still owns about 30% of the shares, and there isn't a ton of free float going around at the moment. But I think it's arguably one of the best penny stocks that you can find. It's such good quality. And they're starting to win now major deals as well, and they're global. So the software here can provide anybody in South America. They recently picked up a very large deal for them. So yeah, I think that's just a bit of a shout out for Cerillion. Really, if it wasn't for the fact that I had to sell them, and I would for me it's a missed opportunity, but it wasn't because I sort of sold too early or anything like that. Basically, I was deciding what billing system my company was going to go with, and they were shortlisted. So it just reeked of having an interest in them. That I would rather have had the decision in deciding what billing system we went with rather than keeping my shares. So it was like, which one am I going to excuse myself from ultimately, right? And this felt more proper. I'd rather just miss out on a little bit of profit from that. But I just like a lot of this stuff as well. Kainos, I have a mid-sized position in Kainos. To me, this is a really good play on Workday. It's the main European Workday provider, as well as having their own custom software house, but it's already a very profitable company, whereas Workday is struggling. And so I think that's cool. It's a good system, by the way, Workday. I like it a lot. But yeah, I think Kainos is your best play into that, as well as being a solid tech company. And I'm pretty sure there was one other one as well I just wanted to mention. Let me just remind myself. Oh, and AJ Bell. So I thought this one was also interesting because to me, and I use a free brokerage, right, Trading 212, which is not perfect, but considering it's free, I'm quite happy with it. But a lot of people are either not wanting to use those, or want the safety maybe of a larger wealth manager. AJ Bell does that. What's amazing to me is how profitable AJ Bell is. I mean, you're looking at 40% net profit. It's just incredible how much money and how willing people are to pay these kind of premiums for these services that to me just always really seem very expensive. But again, I think it's a good play if you believe that premium chargeable services in wealth management are here to stay. I'm not super convinced myself, but again, the numbers seem to speak differently. So yeah, I actually looked into AJ Bell super recently. They put some numbers out, and yeah, it was 40 something million on 110 million revenue. It's that is amazing. These are the kind of profit margins that anyone would bite your hand off for. So I think there's a ton of interesting companies here. I can't say I'm familiar with all of them, of course. I probably know about half of these companies before I spend any time. And I've had a brief look on some of the larger positions, but I think every company that I'm familiar with is either a good value opportunity and or very good exposure in basically they're best in class, right? I don't see certain recruiters that I think are less good, but then I see others that I rate more highly, right? ST3 was on the other page. Again, you've got Robert Walters here as well. There's just and similarly with insurance as well. Hiscox is a really good shout as one of the mid-sized insurers. Does sort of professional insurance, let's call it. So things like cyber fraud and things like that. I think again is a good exposure to have. in that area. So yeah, just really excited here. Computer Center, I think, might be a FTSE 100. It's one of the few FTSE 100 ones in here, but it's definitely one of the larger holdings that they have. And again, this is a company that I sort of thought about when I first started investing and never bought into, and was like, it feels like I missed something there. So yeah, just I really liked it. It's got like a modest, a 0.5% management fee, which I guess is on the larger side, but it's managed, so it's kind of in the region I expect it to be. And yeah, it's kind of, again, a modest outperformance, a modest discount to net asset value, and I just love a lot of their holdings, basically. So some of these I'll try and get a bit more familiar with over time. Again, I only opened up this ETF this week, having never even heard of it before. But anyway, let me know your thoughts on any of the companies I've covered, or indeed the ETFs in general. Otherwise, thank you very much for watching, everyone. Another long video, but I appreciate it. I've been the Boss Hog, and good luck with your investing. Bye for now.